You know, if you lose a job, it sucks. If your neighbor loses a job, it sucks. But when unemployment goes from 3.4 to 3.6%, it's good news? I don't know. Here's the thing. Our unemployment report that just recently came out showed the unemployment rate jumping from 3.4 to 3.6%. Part of this is because of the household survey showing that there were 177,000 job creations, but the labor force increased by 419,000. Also, one of the big things that MBS Highway pointed out today was that there was a jump of 343,000 people who are currently on unemployment that have been there for less than 5 weeks. That means that they lost their job recently and they haven't been unemployed chronically. It's less than 5 weeks. It means it's taking longer for people to get hired. We also had a report that we were looking at yesterday that showed basically the first time in over 10 years that major job losses were occurring in all 30 sectors, 30 major employment sectors that are tracked. So we're starting to see this job loss issue come up. This is what has positively affected mortgage-backed securities. In the last 2 days, mortgage-backed security prices have gone up about 100 basis points. That means that rates are starting to fall. What's the other news that we're looking at? This coming week, we have the Consumer Price Index. We have the Fed meeting coming up as well. And Jerome Powell and his cast of merry fools were talking on Monday. They were talking Tuesday. He was talking Tuesday and talking Wednesday. The market doesn't seem to like him. It appears that every time he opens his mouth, the market reacts adversely. He cannot go off script. Oh my gosh. These guys have a habit. They get it wrong. They make the wrong decision. They made the wrong decision on inflation and when to tamp it down. And now they're making the wrong decision on how high to increase the discount rate. We're probably going to see an increase at the next meeting on the 21st and 22nd, but it's stressing small regional banks. We saw SVB, Silicon Valley Bank, is having major liquidity issues. I think they showed a $1.8 billion loss. Trading has been stopped on them because they weren't able to raise capital. And then we also have that one crypto bank that is going boink. And the Silicon Valley Bank is the interesting one. The reason why it's so interesting is because in order for them to hedge their risk, they will take their deposits and they put them in to treasuries, say like a 2-year treasury. Well, if they got a 2-year treasury a couple of years ago, it had almost no interest that it was paying because rates were so low. Now, if they were trying to sell that 2-year treasury now, and let's say they got it a year ago, if they were trying to sell that same 2-year treasury right now to get liquidity, because interest rates have gone so high, those bond prices have significantly decreased. So what you would think would be a safe investment for a bank is costing them because they cannot hold this treasury to maturity. And this, as I said, it's only really affecting the smaller regional banks. The larger banks, thank God, have the liquidity to go through it. Yesterday, Houston Association of Realtors released their February results. No big surprise. Most every segment is down year over year. Well, duh. Of course. When you've got interest rates at 3% or 4%, and now you've got interest rates at, say, 6.5% or 7%, you're going to see volume decrease. But here's the thing. Volume is still better than pre-pandemic levels. And interest rates before the pandemic were much lower than they are currently today. So that's actually really good news in the housing market. Things, though, that I'm looking at that still make me a bit nervous, we really don't have that much inventory. Nationwide, they're saying there's about 2.9 months of inventory. In Houston, they're saying that we have about 2.6 months of inventory. In February of 2022, we had 1.2 months of inventory. When you take out pending sales, there was zero inventory. There was like that one house that had a conga line of 700 people wrapped around it. They were throwing money. They were offering to name their firstborn child, blah, 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 blah. That's what was going on in real estate. Today, with that 2.6 months of inventory, you take away that 1 month that's already pending, you basically got 1.5 months of inventory. It's still not better. For equilibrium, we've got to have between 4 to 6 months of inventory. What do I mean equilibrium? Basically, for a balanced market, buyers and sellers. So if you've got only 2.6 months of inventory, then we're still looking at the fact that sellers do have an advantage. And I will tell you that recently we've started seeing bidding wars again. The spring buying season is heating up. So we need to make sure that we're out there and that we're being aggressive. Next week, once again, we've got the cost of funds or the CPI report coming out. So that should be favorable as there's going to be no statistical trickeration. And that is pretty much it. So I want you to all have a great weekend. I think that, we got 2 weeks left in rodeo. We have a great opportunity with the market, especially with the mortgage-backed securities rallying. I do feel like Monday or Tuesday, there might be some slight retrenchment. But Wednesday's CPI report could be very beneficial. If you got any questions, give me a call, 281-841-1723. Thanks, Rich. Be well.